I want you to remember this exact moment, the date, where you're sitting, maybe what you were eating when you clicked on this video. Because if I'm right about what I'm about to show you, you're going to come back in 6 months, maybe a year, and say, damn, that was the moment. That was the one. And we're talking about what I genuinely believe could be the next 10 bagger hiding in plain sight. And by the end of this video, you'll either agree with me or you'll have a really good reason why I'm wrong. Either way, let's go.
Here's what we're getting into today. First, I'm going to give you a quick read on where the market actually stands right now, because context matters, and I'm not just going to throw a ticker at you without setting the table. Then we're going to talk about why most of what you're hearing from financial media right now is designed to make you panic and not designed to make you rich. After that, we'll get into my selling framework. 4 questions I ask before I dump any position, because knowing when to hold is just as important as knowing what to buy. Then I've got a couple of ideas I want to walk you through, including one that I think is deeply undervalued and flying under the radar right now. And yes, somewhere in the middle of all that, I'm going to tell you about today's sponsor. But I've actually been using this tool myself, so it's worth 2 minutes of your time. Stick around. This one's dense, but I promise it earns every minute dot real quick before we get rolling. Nothing in this video is financial advice. I'm not your advisor. I'm not your broker. I'm not your fiduciary. I'm just a guy who spends an unhealthy amount of time thinking about stocks. You do your own research, do your own due diligence, because if you're the one taking the ultimate risk, you've got to be the one doing the ultimate frisk. That's the deal. Okay, now we can actually have some fun. Let's talk about where we are, because I know a lot of you opened this video in the middle of a pretty uncomfortable stretch. We've seen some serious red days lately. Certain sectors are getting hit hard. The headlines are screaming recession. The talking heads are debating rate cuts like it's a religious argument. And if you've been watching your portfolio, you've probably felt that little twist in your stomach. I get it. That feeling is real. But here's what I want you to understand. The feeling is not the analysis. Those are two very different things, and conflating them is exactly how retail investors get shaken out of positions they should have held for years. Here's the thing about sell-offs. They are not signs that the economy is ending. They are signs that something changed, or more often, that the perception of something changed. Right now, what we're dealing with is a market that got a little ahead of itself on rate cut expectations and is now repricing around the idea that the Fed might stay higher for longer. That's not a disaster. That's a recalibration, and recalibrations are where generational wealth gets built, if you're paying attention and if you have a framework instead of just vibes. So a lot of people are looking at this red on their screen and thinking, should I just get out? Should I go to cash and wait? And look, I hear you. I'm not dismissing that fear, but ask yourself this: what exactly are you waiting for? For the market to confirm the bottom. By the time that confirmation comes, you've already missed the first 20% of the recovery. That's how it always works. The bottom doesn't ring a bell. It sends an invoice after the fact. The second fear I'm seeing everywhere is this idea that high interest rates are a death sentence for growth stocks. And yeah, rising rates hurt valuations mechanically. That's true. But here's what people miss. Not all growth is created equal. A company with real revenue, real margins, and a dominant market position in a sector that doesn't need cheap money to grow is a fundamentally different animal than a money-losing startup that was propped up by 0% rates. The market is making a mistake right now by painting the whole sector with the same brush. That mistake is your opportunity. And the third fear, and this one's the sneakiest, is just the relentless drumbeat of negative sentiment from financial media. I'm not going to name names, but you know exactly the shows and the channels I'm talking about. The ones where every single segment somehow ends with, and that's why you should be scared. That's not analysis. That's a business model. Fear gets clicks. Fear keeps people watching. Fear sells ads. The moment you understand that the media's incentive is engagement and not accuracy, you stop letting it drive your decision-making. I want to sit on this point for a second because I think it genuinely matters. The financial media machine is not your friend. It is not designed to make you money. It is designed to make you feel like you need it, which means keeping you anxious, keeping you dependent, and keeping you coming back for the next segment. The best investors I've ever studied, and I mean really studied, like read their letters, watch their interviews, track their actual decisions. They almost all share one trait. They consume less news than you'd expect. They go deeper on fewer things rather than shallow on everything. Keep that in mind as you build your own process. So let me close out the macro section with something simple. When you strip away all the noise, when you ignore the headlines, and just think about the structural reality, the Fed has 2 options. Option 1, they print money, rates come down, the economy gets stimulated, and risk assets go up. Option 2, they don't print money, the economy slows enough that things break, and then They print money, rates come down, the economy gets stimulated, and risk assets go up. You see where I'm going with this? The destination is the same. The only variable is the timeline. So the question isn't if the market recovers. The question is whether you're positioned for it when it does. Quick word from today's sponsor before we get into the picks. And I'm going to keep this short because I respect your time. Is a tool I've actually been using for about 3 months now, specifically for screening earnings reports and building quick valuation models without having to build a spreadsheet from scratch every single time. If you're the type of person who likes to go deep on individual companies rather than just buying index funds and hoping for the best, this is genuinely useful. Link is in the description. They've got a free trial so you can kick the tires before you commit to anything. Okay, that's it. Back to the good stuff. With that out of the way, let's actually talk about what to do with your money. Before I get into any specific names, I want to address something I know a bunch of you are already thinking. Because you've been with some of these positions for a while now, and you're wondering whether it's time to take some off the table. So here's my framework. There are 4 questions I ask myself before I sell anything. First, has the thesis changed? Not the price, not the chart, not what some analyst said on TV. Has the fundamental reason I bought this thing changed? If the answer is no, then a price decline is not a reason to sell. It might actually be a reason to buy more. Second, is there a better opportunity cost? Sometimes you're not selling because something went wrong. You're reallocating because something else is just clearly better on a risk-adjusted basis. That's a legitimate reason to trim. Third, am I selling because of fear or because of logic? These feel identical from the inside. They are not. Take a breath and figure out which one is actually driving the impulse. And fourth, does the position size still make sense given where the stock is today? If something's run up significantly and it's now 15 or 20% of your portfolio, maybe a partial trim to rebalance is just good risk management, not a full exit. Run those 4 questions before you touch anything. It'll save you a lot of regret. Now, a few quick retrospectives because I think context matters here. Applied Digital. APLD. I talked about that one when it was deeply unloved and the short interest was enormous. The argument was simple. Data center infrastructure for AI workloads was going to be a choke point, and this company was building the capacity before the demand fully showed up. The stock has had a massive run since then, and I'm genuinely happy for everyone who was in it. But I'm not going to tell you to buy it here. The upside I saw at the original thesis level is largely priced in now. If you're in it, run my 4 questions. If you're not, there are better spots.